Hi, this is Richard Flax at MoneyFarm with our regular monthly update. There's a lot to talk about this month, but we'll focus on the new US government and trade tariffs, artificial intelligence, and corporate earnings. First on tariffs. We've seen a lot of activity from the new administration in the US, and that's included announcing tariffs on a number of trade partners. Mexico, Canada, and China have all been targeted, and the president has threatened tariffs against the European Union in the near future. Equity markets initially fell in response to the news, but after discussions with various leaders, it seems that the US will delay implementing tariffs against Mexico and Canada, but probably will go ahead with a new tariff on Chinese goods. China looks set to retaliate. So what does all this mean? We know that the president generally likes tariffs as a way of raising tax revenues and negotiating with partners. The administration seems prepared to accept that higher tariffs could mean higher inflation and slower growth in the short term. We should say there is some debate about whether we'd actually see sustainably higher inflation in this scenario. It could be that companies feel they can't pass on tariffs to their customers in the form of higher prices, and we see margins come under pressure. Our general view, though, is that a round of higher tariffs would slow down growth and probably raise prices, and that could be tricky for risky assets. There are, though, a couple of points to make. First, investors have had some time to digest the prospect of higher tariffs. The president's been talking about them for some time. Second, it does look like he's using tariffs as a negotiating tool. That could mean that the tariffs we do see are more targeted and so have less of an impact on the overall economy. January also saw some interesting moves in the artificial intelligence arena. A Chinese AI researcher, Deepseek, released a new model that performed very well against global peers. It was suggested that Deepseek had achieved these results using older and cheaper technology, and at a fraction of the cost compared to US peers. That conclusion raised concerns about future demand for the newest and most expensive processing units, and also raised questions about whether all the money that large tech businesses are pouring into AI will generate the sort of returns they're hoping for. Maybe AI will soon become a commodity that everyone has access to. These concerns prompted weakness in some large tech stocks, most notably Nvidia. We think it's too soon to say that the Deepseek results are a real threat to the incumbent tech businesses. For now, we think demand for Nvidia's products will remain strong. The large tech businesses will continue to invest and look for ways to make money out of AI services. That said, having cheaper alternatives could spur increased overall investment in the space, improving adoption and innovation. At the same time, we remain aware that expectations for the large US tech businesses are still high, and we're looking to broaden our equity exposure. Finally, we're seeing US companies report their earnings for the last quarter of 2024. We won't have all the results for another few weeks, but it looks like US companies ended last year in pretty good shape. Companies that had reported by the end of January, around a third of the total, reported year-on-year profit growth of around 13%, according to FactSet. If that's maintained, it would be the fastest quarterly growth since the fourth quarter of 2021, when US companies were coming out of COVID. As we've already said, expectations in the US are already high, but listed companies are generally performing well. So we've certainly seen a lot of activity from the new Trump administration, and that's translated into some more uncertainty in markets. It's something we'll continue to monitor in the coming weeks and months. But overall, companies, particularly in the US, continue to have some helpful tailwinds as we move further into 2025, notably decent economic growth and lower interest rates. Thanks for watching, and look forward to speaking with you again soon.